Hey everybody, my name is Jake. Welcome to the channel. Before I dive in today's video, I want to take a second and I want to say thank you. Thank you to everybody that has supported the channel by subscribing, by liking, by commenting on the videos. It means so much to me. I started this YouTube channel about 6 months ago. And as you know, when you start a channel on YouTube, it's not the fastest thing. It doesn't always grow incredibly quickly, but in the last week alone, we've grown about 50%. And here on the channel. And I just want to say thank you. Thank you so much. In today's video, I want to talk about starting a brand new dividend growth portfolio. Last year, a year ago, so in December of 2018 was when I really first started learning about dividend growth investing, when I started really to slowly pick individual companies and ETFs that followed that strategy of a dividend growth model. And in today's video, I want to share with you how to get started. In my last video, I shared 4 different things that I've learned along the way. And in this video, I want to share with you a few things that you can do to get started. Because that's really what it comes down to, is getting started. And if you're watching this video and you've never heard anything about dividend investing, it's because you don't learn about it in school, or no one you associate yourself with either at work, at friends, or your family, they might not be investing into this kind of a strategy. So this may be the first thing that you've ever heard about dividend investing. And on my channel, I really am addressing newer investors, beginner investors that are really first starting out. They've maybe heard of the concept before, like, yeah, I'm going to retire on dividends, but not really understand fully what it means. And on my channel, that is what I talk about. And I share with all of you very transparently. As you can see here on my screen, this is my M1 Finance portfolio. I'm sharing exactly what I'm invested in and sharing with all of you what is working and what is not working, right? And in my last video, I shared very candidly, like, things that I've done, mistakes that I've made along the way, right? And so you might be kind of going through that phase where maybe you hate your job, maybe you're stressed, maybe you need to find a new source of income, right? You're trying to make means end and you're looking for a little bit more side income. And dividends are a great way to do that. It's incredibly passive, but how do you do it? And it could be a New Year's resolution. I know that, in January, it's time when the gym really fills up. Everybody is, feeling guilty from all the turkey and pie and all that good stuff that they've eaten, and they go to the gym, and that's kind of their New Year's resolution. That might be the case for you, or you may be a little bit more of an experienced investor. I think you're still going to get a lot of value out of this video, even if you're already investing into dividends. So in today's video, I have it laid out where I'm going to take everybody kind of step by step. What are some of the most important things that you should be doing when you're first starting out and building a portfolio? And I'm actually going to show you in M1 Finance a pie that I've created as if, something that I would recommend. I'm not a financial advisor, but something that I would recommend as a good starting point for a traditional or a retail or, normal investor looking to invest in a dividend growth strategy. So in this video, I'm not going to cover everything. There's so many different things that you could learn about dividend growth investing, but this is really to help you get started. Okay, and I promise everything will tie in together if you watch the entire video. So stick with me here. The very first thing that I want to talk about is really understanding your goal. So if you're first researching about dividend growth investing, why are you doing it? What is your goal with accomplishing that? I think the most important thing that you have to understand there, that it's a long-term investment strategy. It's not a get quick win. You're not investing everything into Bitcoin or on the roulette table and hoping to win everything, but also potentially lose everything. So that's important to understand, that it is a slow and steady investment strategy. And something that has helped me is going over here to Investopedia and checking out their dividend investment calculator. And what this is it helps you to understand, okay, if I invest a certain amount of money every single month at a certain dividend rate, what is that going to give me in X amount of years? And I'll leave a link to this in the description of the video so that you can go play around with this. I'm not affiliated with them. I just use it. I think it's a great tool so that it really gets you thinking that, okay, is this a strategy that I'm interested in? And the cool thing is you can base it off of your age, and you can then play around with it and see, okay, if you're in your 50s, you need to change the strategy up. Whereas if you were in your 20s, you can maybe be a little bit more aggressive, for example. But I'm not going to get into that into this video, but I want to share a quick example. This is a real life example for me right now. So I have about $30,000 in my portfolio. So with my main cash portfolio and my real estate, my REIT portfolio, it's about $30,000. And currently I'm investing about $300 a week. And that equals out to about $1,300 every single month. And what I'm striving for is a 10% dividend growth rate. So every single year, my investments, the companies that I'm investing in, they're growing 10%. And then my current assumed yield that I have right now is about 2.8%. So not a crazy amount, but also not crazy low. So a decent yield. The next thing here is the actual length in which I'm investing. So in this scenario, I'm looking at 15 years. Inflation, it's hovered right around 2%. So I'm a little bit conservative. I put 2.2. And the assumed growth rate of the share price is about 7.5%. That's within line conservatively with the S&P 500. And I am currently 33 years old. And so when you go ahead and when you calculate this, you can see, okay, over the next 15 years, if I were to try to retire at 47, my annual dividends that I'm going to be paid is $28,000. That's not a lot of money, especially if you adjust it to inflation. It's about $20,000, right? But however, the actual portfolio value, I mean, it's a decent sized portfolio. It's almost $800,000. So it's a good sized portfolio. So if you're in your early 20s or if you're in your 50s and you're thinking, okay, what do I need to do to, because not everybody can live off of $28,000. What can you do to increase that? So there's a few things that you can do. Unfortunately, I can't change my age. I'm as old as I am. I can't change that. But what I can do is I can change, for example, the time period or the time horizon that I'm going to be investing in. I could change, okay, I want to get a little bit more aggressive and I want to make sure that my investments are growing. So I want to shoot for a 12% dividend growth rate. And I hate to break it to everybody, but for this strategy to work, you have to invest money. So if $300 is not going to cut it, then maybe I have to bump it up a little bit and say, okay, all right, well, I'm going to start investing $1,500 on a monthly basis. And that's something that you can do, right? And then when you go down here and you calculate it, all right, after 20 years, if I'm seeking to retire in 20 years, this is the amount of money that I'm going to have when I retire. So adjusted for inflation, it's about $70,000. So this is a great way for you to start thinking, okay, is this a viable strategy for me as a new investor to start pursuing? And like I said, this is a long-term play. This is not a get-quick strategy, okay? But I think, it's important. And the reason why I've shared other videos on why I've chosen dividend growth investing, but what I'm really looking for is I'm looking for those earned dividends. The capital appreciation, that's icing on the cake. It's nice to see, but what I'm really looking for are my earned dividends. The earned dividends are what I'm going to use to then pay for my living expenses. Let me give you a simple example, right? Right now I have a mortgage, I have property tax, I have insurance, all that good stuff. What I'm trying to do to be able to be financially free, my passive income, for example, my rental income through my rent or my dividends, they have to be able to sustain my living expenses and some. So for example, if I have a utility bill that's $50, I have a rent, I have to pay a mortgage for, just hypothetical, $1,000, whatever it may be, my passive income, my dividends have to be able to sustain that and pay for that. And so that is what I'm striving for. Most people traditionally, when they think about investing, they think about investing, into their 401k. They're going to, work until almost until the day they die, until they're 65, 67. And then what they're going to do in retirement is they're going to then sell off the actual capital. So what they're going to do is they're going to liquidate about 4% of their total portfolio every single year, and they're going to live off of that. That does not create generational wealth. What I want to do is I want to live off the dividends. I want to live off the passive income and be financially free. And then once I, enter the grave, I know it's kind of not the most exciting thing to talk about. I want to be able to leave that behind for my family. Right. And that's something that I've thought a lot about. And that's one of my goals. And that's one of the reasons why I'm investing in a dividend growth strategy for that generational wealth. And the topic here is, it doesn't matter if you're in your 20s or if you're in your 50s, you can still accomplish it. You just have to, once again, you have to look at the numbers. You have to make the numbers work for you. So that's the very first thing. Okay, when you're first starting out a dividend portfolio. All right, the next thing that you want to do is you want to keep it simple. You have to keep it simple. And when I say keep it simple, I don't always mean follow my lead here always. One of the things that I get the question about more often than not is, whoa, I have over 90 holdings in my portfolio. Okay, I've gotten a lot of questions around that. Wow, why am I doing that? I think it's important to understand that everyone is going to have a different strategy. I do not recommend this strategy for everyone. By no means. I think, when I look at other people, and just a random example, when I look at people that, I talk to people, they have like 4 or 5 or 6 brothers and sisters. I always ask myself, what were their parents thinking? How could you have 6 kids? For me, that's just not my, I didn't grow up in that environment. It's just not something that I can see myself doing. Just as much as I don't think everyone should have 6 kids, I don't think everyone should have 90 plus holdings. And it's also not required, right? You don't need to have 90 holdings to reap the benefits of dividend growth investing. So I want to be very, very clear. This is not financial advice. This is something that I'm doing. It works for me, but it may not work for you. And that's okay. You can do it. You can take a little bit of a different approach. And I'm going to talk about that in a second here. Okay. So when you're investing into companies, the important thing is that you don't want to just go and blindly invest into a company that you've maybe never heard of or you know nothing about. I'm not saying that you need to know everything, but I think it's important that you understand what you're investing in to a certain degree, right? When you read the description, what is this company doing? And you need to be able to understand it. Warren Buffett always talks about being able to invest into your circle of competence. You want to know what these companies do. For example, Union Pacific. What does the Union Pacific do? The railroad. I mean, I think a lot of people understand, okay, it's that loud thing that drives by me, a couple times a day, or whatever. Waste management. I think a lot of people understand and know what waste management is. And that's kind of what I would recommend when you're first starting out building a dividend portfolio. And if you are going to look for individual companies, and I'm going to talk about that in a second here, but if you are going to invest in individual companies, try to invest into your circle of competence. When you're going to go and pick these different companies, have you heard of them? Have you heard of Apple? Do you know what Visa is? Do you know what Microsoft does? Do you know what Intel is? I'll give you a few other examples here. Do you know what Disney is? Have you ever heard of McDonald's? Have you ever heard of the Olive Garden? Have you ever been to the Olive Garden? Have you ever stayed in a Marriott? Are you currently wearing Nike shoes? Do you go shopping at Target once a week, right? Understand, okay, do you understand these companies? Right. And it doesn't just have to be consumer facing companies. It could also be B2B companies, companies that have not so much a consumer facing product line, but rather a business to business product line. Maybe you work for a company that works with one of these companies as a supplier. Maybe somebody that's a painter that really works with PPG paint, or Sherwin-Williams, or whatever it may be. So trying to understand, okay, what you're getting invested in. And when you're first starting out, when you're first starting to invest, now these are words of wisdom, everybody. What I would first recommend is slow and steady. Slow and steady is going to win the race here. All right. In my portfolio, I have just over 90 holdings. 6 of these holdings are actually ETFs, exchange traded funds. And each of my holdings have performed differently. I have some companies in here that are down, for example, Boeing, Kraft Heinz. I have other companies that are doing incredibly well, AT&T, AbbVie. Coca-Cola, Kellogg's, a lot of these companies are doing really well. And so there's going to be times when they're doing well, and there's going to be times when they're down. There were times middle of last year where I was down on Altria Group. I was down on AbbVie. I was down into other holdings, but it's okay because it's a long-term investment. Okay. Now, what I want to do is I want to go into the part of the M1 Finance platform here, and I want to share with everybody a portfolio that I built this morning, and kind of thinking about, all right, thinking about the audience who's watching my videos. If you're a newer investor or a beginner investor, you probably might get intimidated by seeing, oh, 90 holdings. That's not for me by no means. All right, well, let's keep it simple. This is a portfolio that I built here. And when I talk with my wife, who has no previous investing experience, or somebody that is a newer investor, this is typically where I start. If you want to invest just into ETFs, go for it. I think that's a great option. I think most investors would actually benefit with going strictly the index fund or ETF route. Absolutely, go for it. A few examples that I really like are, for example, DGRO, VIG. I'm a big Vanguard fan. VOO is just a S&P 500 index, has an incredible dividend growth rate, as well as VTI, the total stock market. There's over 7,000 individual holdings in this ETF, has an incredible dividend growth rate. So it doesn't just have to be a specific dividend growth ETF to get a dividend growth rate of 7+%, for example. So this would be the historical gain of the last 5 years if you just went with these high quality, broad-based, low fee index funds, just over 62%. All right. Now, if we were to go here, this is a pie that I built where this is something that I would recommend. If somebody were to come and ask me, hey, Jake, I'm a new investor, what would you recommend if I did want to invest a portion of my portfolio into individual stocks? This is what I would recommend as a starting point. This is not financial advice. This is just me saying, okay, this is something that I personally would see myself doing, or share with somebody that my family or my friends. This is what I would recommend. Companies that are well established, have a great track record of dividend growth, meaning that they're a dividend growth aristocrat, or a dividend aristocrat where they've increased their dividend over the last 25 years, where they have a very strong product line, where they have a competitive advantage, they have an economic moat. I've talked about these things, economic moats and dividend aristocrats, in previous videos. If you're interested in that, you can go check out those videos. But this is a sample portfolio of what I would think would be a great starting point. So if you're starting to invest in January of 2020, and you're unsure of the market, you're unsure of, okay, are we going to enter a recession tomorrow? Am I going to lose everything? This is a portfolio that you could start investing in, and you could sleep well at night. If we were hit with a recession tomorrow, yes, some of these would go down. The portfolio value would go down. However, the dividends would still be coming in. Think about it as a rental property. If you buy a rental property for $100,000, and then you're getting $1,000 in rent every month, for example, and we were hit with a recession, and let's say, okay, if you wanted to sell that house the next year and you could only sell it for $80,000, okay, that would be a 20% loss, for example, among other things. However, if you kept it and you're still getting that $1,000 in rent, that $1,000 is still coming in as passive income. Now, that is the exact same thing with dividend growth investing, where if the share price goes down, that is actually a good thing. You want it to go down in some cases, really, so that you can buy in at a lower price point and increase your dividend yield, your yield on cost. And then that yield on cost, that's yours. And then once the share price appreciates, you still have that yield locked in. Now, that is the power of dividend growth investing. Now, you're not going to be getting this 2%, this 2.5% forever. That is going to be growing. That is why we talk about dividend growth. Okay. So that is a sample portfolio that I've built, and I'll share it in the description if you're interested in checking that out. Once again, this is a sample portfolio, something that you can at least start with. Another thing that you could do right? And let's say, okay, for example, if you have M1 Finance, you can go in and then you could start with this, and then you could add in another slice. You could add in, for example, more real estate. You could add in more ETFs. You could decrease it, whatever it may be that fits your approach, your risk tolerance. That is and you could, it's yours. You can take ownership of it, right? And so that's what I mean by keeping it simple, right? And you don't have to have 90 holdings. I do have 90 holdings in here in my portfolio. And, I'm not overwhelmed. I don't look at every single holding every single day. I don't listen into every conference call, every earnings call. And I'm going to talk about that in just a second here. But before I do, the next thing that I want to talk about in terms of getting your portfolio all set up and ready to go is something that you really have to manage, especially with the market being in a bull run for over 10 years. You want to focus on emotions. You want to eliminate emotions. And how you can eliminate emotions in your investing is through dollar cost averaging. If you're dollar cost averaging, you're taking the emotions completely out of it. And so how you can do that, and this is how I do it with M1 Finance. You can do it with another brokerage, but how I do it with M1 Finance is I set up automatic transfers. Every single week, I'm transferring money into my portfolio. Now, times change, right? If you follow my channel, you know that I recently purchased a rental property, which I had to save for the closing costs, the down payment, all of that stuff. So for a couple of months, I dialed back my weekly transfers. But now once I'm back on track, I'm not having to save money for that expense, or a life expense. I have my transfers back going, into my real estate account and as well as into my cash flow account. I'm trying to invest every single week. In my portfolio, because I've been with M1 Finance for quite a while now, I've been grandfathered into their new setup. Today, if you were to set up an automatic transfer, you'd only be able to do it twice a week. Because I was grandfathered in, they kept all of my transfers. If I were to ever delete these, I would only be able to do 2 a week. Just in case you were curious. But yeah, you want to invest it every single, at least every 2 weeks. I mean, you don't have to do it every day. You don't have to do it twice a week. But I think kind of that sweet spot is once a week. You're transferring over once a week. And that's what I do, right? And, you can see here, I'm very consistent with it. I'm trying to fund the account. And coming back to what I mentioned earlier, you have that goal, you want to retire in 20 years, for example, here, or 15 years, you have to fund your account. There's really no getting around it. I wish there was an easier way to put it. I wish I could say that it's not so, but it absolutely is. You have to make money. You have to be able to fund your account in order for this to work. It's essential. There's no getting around it. Okay. So by automating it, by dollar cost averaging, you're taking away the emotion of investing. And I think that is what is so difficult for new investors, especially, I can't tell you how often I get asked, should I invest in 2020? Should I do it? Is it safe? I think it would be naive to say, okay, we're not nearing a potential end of an economic cycle. We've been in a bull run for 10 years. However, I could have said that last year. Last year in December, I remember December 28th, I still remember saying, oh, I'm going to wait until it goes down a little bit more. And in 2019, the market went up about 30%. So even now, even since January, in the last week, the market has been going up, right? So when I get asked that question, I would say, okay, don't be naive. Understand that we are at all-time highs. Yes, so you want to be particular with the companies that you're investing in. You want to do your research, but I believe by dollar cost averaging, you're going to have superior returns had you try to time the market. If you try to time the market, the odds are against you. Okay, you might as well go to Vegas. It's kind of how I rationalize things. Okay, so dollar cost averaging, controlling your emotions through automation. Okay, now the next thing that I want to talk about is as you're growing your portfolio, you're going to see, okay, the performance, you're going to track it. Okay, over the last week, I made over $18 in earned dividends. I didn't have to work for that. I worked for the capital, the money that I invested into the portfolio, but these $18, that was passive income. That was paid to me through my investments. Here in the last month, I made over $75. Same thing, purely passive. This is what I'm looking to grow, is my earned dividends. All time, I've gained over $500 in earned dividends. That's not nearly enough to retire tomorrow, on tomorrow, but I understand that. I'm not looking to retire tomorrow. I got a little ways to go before I can reach retirement, so it's going to take me some time. However, with all of these investments, whether you have 10 holdings, 5 holdings, 1 holding, I think it's important to understand that you don't want to stress how much you're following up on these companies. If you do choose to invest into individual companies, you don't, in my opinion, I don't believe that you need to overly stress about keeping up and following with these companies. Now, I know a lot of people, when they hear that, are going to think, what are you talking about? That's stupid. Why would you ever say something like that? I don't believe you do. And there's another investor out there that actually agrees with me. When Warren Buffett was interviewed on Yahoo Finance with Andy Serwer, talking about Apple and, if Warren Buffett was concerned about lower sales, future growth, Warren Buffett had this to say.
Well, if you have to closely follow a company, you shouldn't own it.
Really?
No, if you buy a business, if you buy a farm, you go up and look, every couple of weeks to see how far the corn is up, and you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that. You buy a farm.
Right. I love it how Andy responded there, that he was actually really surprised, because conventional wisdom is, okay, if you're going to invest into a company, you have to spend hours upon hours following up on the company, making sure that you're reading all their earnings and all of that stuff. No, you don't have to do that. When you're investing into a long-term strategy like this, like a farm, right? This is obviously different than a farm. If you're purchasing the farm, not actually owning and managing the farm on a day-to-day, but if as an investor you're purchasing the farm, or in this case, if I'm purchasing Disney, I'm not going to look and read up on Disney's earnings every single week, every single day. I'm investing into Disney because I believe that Disney is going to grow over the long term. Similarly with other companies, right? If I were to look into my financial sector, I believe that, Wells Fargo, even though they had a really bad week last week, I really believe that Wells Fargo is a good long-term investment, as well as Travelers Company. I think if you're just investing for the short term, it creates a lot of stress, and I think that is not what we're talking about here in terms of dividend growth investing. Okay, another example. This is specifically talking about technology. Technology is a very difficult industry to read into for me as a dividend investor, because it's difficult to forecast and understand, okay, who's going to be who's disrupting who's going to be that next disruptor, and who's going to be the next blockbuster, who's going to be the next Circuit City. It's difficult for me to kind of see into that. But I want to take a look at one more piece of that interview from Warren Buffett, when he's talking about, okay, if you have to invest into, if you have to do the research and follow up on all these companies, maybe it's not really the right approach for you. But let's hear it directly from him.
You buy it knowing there's 365 days a year, and you're going to own it for 20 years, so that's 7,300 days. And things are going to be different from day to day and year to year. You shouldn't buy it if the day-to-day stuff is important.
All right. So if you feel like you have to follow up every single day on your investments, it's probably not a good investment for you. I know when I first started investing in dividend growth stocks, it gets really exciting. It's really exciting to see that snowball effect in action, where you're seeing your holdings, your dividends come in, and they're growing every single time. If you look at your portfolio here in M1 Finance, I can take a look at, let's say, for example, let's take a look at AbbVie. With AbbVie, you can see the dividends that, when I got paid a dividend in August, it was only $8. The last dividend that got paid out in November, it was $14. That is that compounding effect. And the thing that I love about M1 Finance is those dividends, when they're paid, say, for example, Disney paid me $3.40 on January 16th. On January 17th, through my automatic transfer on Friday of $100, I purchased 30 shares of different companies. 30 different companies, not shares, 30 different companies. And of that $103, including the dividend from Disney, it purchased the following companies in my portfolio. So companies like Pepsi, Intel, Texas Instruments, and the list goes on and on and on. And the way that it works is it's based off of my target allocation. Because I have the auto invest set on, so I'm auto investing every single time that my portfolio reaches $10, it's going to then automatically, meaning M1 Finance, is going to automatically invest into my underweight holdings. My underweight holdings are set up here, my actuals and my target. So the underweight slices in the portfolio are going to take priority, and M1 Finance is going to then invest into those holdings. And so that's what we call that dynamic rebalancing, where with M1 Finance, it's actually rebalancing it for me. I'm not having to manually click rebalance. If I clicked the manual rebalance, it would cause a taxable event. But through their dynamic rebalancing, it will automatically rebalance my portfolio based off of the target allocation. Okay, so you don't have to follow your portfolio, like your holdings every single day. You don't have to stress about it. However, I think it is important to track your performance. And a way that you can track your performance, one way that I do it, for example, is through Dividend.com's Propeller. Full disclosure, I am not affiliated with them. I just personally use it. It's a new service that they recently started offering, and I think it's great. And they also just recently started offering fractional shares. So before you had to use whole shares, now you can use it with fractional shares. However, with M1 Finance, they don't have an API or a connection where you can integrate it through an automatic upload. You actually do have to manually upload it. It just takes you a few minutes. Even for me with 90 holdings, it only took me about 10 minutes. So with Propeller, this is what it looks like here, the screen. One thing that I do want to note is this is only tracking future dividends. It's not tracking historical dividends. I have a different tracker for that, and I'm going to share that with you in just a second. So if we want to look at the income, over the next 12 months, we're going to be getting projected, because what's in green has been declared. This is what's going to come. What's in gray is what's estimated, based off of how the companies have paid out their dividends in the past. This is over the next 12 months. It's going to be paying me $806. This is just for my cash portfolio. It's not my real estate. And it shows here your upcoming dividend payment. So pretty cool. But once again, it doesn't track historical income. The next thing is going to be to actually view your holdings. This is something that is cool. That you can do is you can actually check and see, okay, the holding value, the dividend yield, the payout, the actual dollar amount, and how frequent they're paying, the frequency, how often they're paying it out. Typically, companies pay it out 4 times a year. Some pay it monthly, some pay it annually, but the majority of them pay it quarterly. Another thing that I really like is you can actually go in and you can see the average annual dividend growth rate. So you can see, okay, how quickly are my investments, my companies that I'm invested in, how quickly are they growing their dividend? And another cool thing, you can see the actual years of consecutive growth. Are these companies a dividend aristocrat? ADM, AFL, ALB absolutely are. Boeing, Apple will soon be a dividend aristocrat. You can go on and you can see, okay, who's paid it the longest, who's paid it the shortest, and so forth. So that's one way that you can track it. Another way that I track my holdings, and I've shared this in a previous video, but just very high level, I also use, through the App Store, I use an app called the stock dividend tracker. I am not affiliated with them. I just absolutely love the app. You can go in and you can see future dividends coming in, also with fractional shares, as well as historical dividends. And another really, really cool thing that I like, probably what I like the most about it is, well, two things. You can see on a calendar when your dividends are going to be paid out. It's actually on the calendar. It's pretty cool. You can see the little logo of the company, as well as when you go into the holding, you can see the actual current yield, as well as your yield on cost, what you're getting paid at the price point that you purchased the stock. So really, really cool stuff. That is how I track it. I also do have Excel sheets that I track it. But when you're first starting out, I think this is a great way that you can get started very quickly, very easily. Also, if you do want to do research, a few things that a few resources, and I've shared other videos on this on how to the best way to invest into different companies, or what are the, how to pick dividend growth stocks. But a great resource that I use almost every single day is seekingalpha.com. It's great, especially if you're looking up, historical dividend history, the dividend growth. You can see, for example, at what rate these companies are growing their dividend. And this is a way that I track it, for example, and see, okay, is McDonald's a good investment? What is their history like? How consistent have they been with growing their dividend year over year? And the last thing here that I'll share with you, if you do want to search for individual companies, something that I use that is very, very helpful is on dividend.com, the dividend screener. You can track here the company essential information, as well as the dividend growth. You can see the years of consecutive growth, their payout ratio. Payout ratio is in relation to their revenue. How much are they paying of their company, to shareholders and dividends in relation or relative to their earnings. So very, very important there. Also, just very basic tidbit. Just because they have a high payout ratio doesn't always mean that it's a bad company. For example, with utilities, they have higher payout ratios. Sin stocks like Altria Group, Philip Morris, those companies, they have higher payout ratios. High growth companies like Visa or other such companies, Microsoft, Apple, they should have a lower payout ratio. So these are a few ways that I track things, how I pick my investments. And yeah, so everybody, I know that was a lot of information. On the channel, I'm going to, in the coming weeks, I have a lot of interesting videos lined up on different topics that have helped me as I've started to invest in a dividend growth strategy, and what I've learned. And I'm going to share some tips and tricks along the way with all of you. If you have any questions, shoot me a message here in the comment section. I answer every single comment. Every single comment I will respond to. So if you have a question, if you want me to check out your pie, like say, for example, you have your own pie and you want to share it, what you can do is you can share the link, send it to me, and I'll take a look at it. I'm not here to critique or anything like that, but I'll share my opinion and my thoughts on it if you'd like. Everybody, I know this was a longer video. I really appreciate it. I really appreciate you sticking with me here. If the video was helpful, if the content was helpful, I'd ask you to, hit the like button, subscribe if you're not already subscribed, and I'll catch everybody in the next video.